Hi everyone, my name's Tammy from WealthMed Accounting, and I'm just going to talk to you today throughout this webinar about what are Division 293 taxes and what are excess concessional contributions taxes. So these are some taxes that pop up every year around tax time that you might have experienced in the past. So I just want to run through to explain to you what they are, when they happen, and how to go about dealing with them. So that's what the webinar is going to cover today. We've got what is an ECC, what is a Div 293, and when they come about. So the first one we'll go through is the ECC, Excess Concessional Contributions Charges. So basically, super funds have a cap of $25,000 per year that you can contribute in as concessional contributions. So your employer puts in usually 9.5% is the required rate of super on your wages. So sometimes you might actually contribute extra contributions on top of the 9.5% as well. So basically, those contributions count towards your $25,000 cap every year. So the ECC comes about when more than $25,000 will go in during one financial year. So what will happen if extra goes in, say you put in an extra $1,000, you've put in $26,000 for a year. The ATO comes along and sees that when you lodge your tax return, and they're going to say, well, that extra $1,000, we're going to tax that at your marginal tax rate. So you might be in the 45% tax bracket. So that $1,000 is going to get taxed at that tax rate. Now, sometimes these contributions, the ECC, is unavoidable because depending on your salary level, your 9.5% super might actually just automatically go over that $25,000. So in that scenario, there's not anything you can actually do to avoid an ECC. So basically, you're just going to have to pay the taxes on that every year. But the good news is that your super fund can actually pay those taxes for you. So that's one positive out of the whole scenario with the ECCs. So like I said, if you've got a salary of around $265,000 and up, 9.5% on that of super is automatically going to put you over that $25,000, and that's when that particular tax will occur. So as I mentioned, super fund can pay that tax. There is also the option to pay that tax out of your personal bank account, which is fine. So we work with our financial planners here, and they will advise on the best strategy for you personally. So they might advise you to pay it out of your super fund, or they might advise you you're fine to pay this out of your personal funds to the ATO. So that's something that they help us with every year as well, and just make sure that we choose the strategy that's right for you with that. So that's the basic of it, but there is a little bit more which can be a little bit confusing as well. So you are actually entitled to withdraw more than what the actual taxes are. So for instance, like I mentioned, if you've put in an extra $1,000 and tax on that at your marginal tax rate of 47%, however, you're actually allowed to take out of your super fund 85% of that $1,000. So that's going to pay the ATO, and then any leftover money from that is going to come from the ATO back into your bank account. So in that scenario, you actually are getting some money back, and you're actually ending up in front from where you were before with after paying the ATO. So now that's just an option. You don't have to take out the 85% of the excess. You can just simply pay to the ATO what is actually owing. So that basically covers the ECC. So it is based on how much money actually goes into your super fund and what is over the $25,000 every year. Now the other one is a Division 293 tax. So a little bit confusing again because they are similar to each other, but they come about in slightly different ways. This one relates to your super as well. So now when you've got an income of over $250,000 on your tax return, the ATO will come along and see that when you lodge your tax return again, and they will look at your super fund and they actually will just tax you an extra 15% on the super cap, which is the $25,000. So in most cases, Div 293 tax will be $3,750, which is the 15% of $25,000 cap. So that one doesn't matter how much money has gone into your super fund for the year. You may have only contributed, let's say, $15,000 into your super fund for the financial year, but if your income was over $250,000, then the ATO is going to come along and put that tax on regardless. So that one is based on your income, not based on your level of contributions as such. So the same thing is going to happen with this tax, is that once you lodge your tax return, the ATO is going to apply that onto your account and say you owe us this much money. Now, again, your super fund can pay that, or you can pay it personally. So if your super fund's paying that, it's fine. We fill out a form and your super fund sends that off to the ATO, which is perfect. So as I mentioned, when are they due is when you lodge your tax return. So once you've lodged that, the ATO does all of their data matching and everything, and they look at your income level and they look at your level of contributions into your super fund, and they can match that up and see. And so some people might have both an ECC and a Div 293. So they will do up both of those usually at the same time and send them both out to you. The thing is, sometimes the ATO is faster than other times. So if you're, for instance, getting a refund on your tax return, the ATO might actually come along and apply these taxes before your refund goes out to your bank account. So in that case, you might be expecting a refund of, let's say, $10,000 for your tax return, and you might actually only get, let's say, $5,000 into your bank. So you might be questioning, well, what happened to the rest of my refund? So it's because the ATO has issued notices for those, and they've just taken the amount that they deem as owing for the ECC and the Div before giving the rest back to you. So if that happens, that's fine. You can still actually fill the forms out and have your super fund pay the particular amounts to the ATO, and then that amount will filter back through to your bank account because you've essentially already paid that out of your refund, out of your own money. So that's perfectly fine. In either scenario, your super fund can still pay those. If you have got a self-managed super fund, you have to actually wait until you've lodged your personal tax return as well as your self-managed tax return before the ATO will actually pick up and data match all of that information. So let's say if we lodge your personal tax return in July, but we don't lodge your super fund tax return until perhaps April of the next year, it won't be until April, when both have been lodged, that they'll pick up these taxes. So that will come about then. So it can be a little bit, sometimes you might forget that they're coming, but the ATO will definitely send those through as soon as both have been lodged. So I've just got a quick example here of Div 293 and an ECC on the slide. So we've got, let's say, if your income was higher than $250,000, you've put in super contribution of just over the cap limit, you've gone $650 over. So even though you're only a tiny bit over, just because your taxable income was more than the $250,000, the Div 293 is going to apply, so $3,750 owing for that one. Like I mentioned, you can have both ECC and Div 293. So the ECC is going to look like, well, you've put in $650 in excess contributions over and above the cap limit, highest marginal tax rate, 47%. That's going to be a bill of $305. So like I mentioned, you can either just pay the ATO the $305, or you can actually draw out 85% of that excess contribution of $650. So you're allowed to actually take out, in this instance, $552.50. So obviously your $305 goes off to the ATO, and the remainder comes back into your bank account, which is basically just, to boost your offset or your savings, can be used that way. So like I mentioned, our financial planners are brilliant at doing up a plan that's best for you and seeing where you should pay it from, how much you should take out, and making sure we get that all covered. So I know that a lot of people get confused around those two taxes when they pop up. You know, some people have them every year, but they are quite confusing, and because there are two that are a little bit similar, it can be hard to remember what each one's for, when it's coming, how much do I have to pay. So that's just a little bit of a rundown of both of those. Of course, you know, if they're come out every year, or if they've come out and it's your first time having one, we always send them out to you and explain what's going on, what the financial planner has recommended you take the money from. We provide the forms for you to fill out to pay the money from your super fund. So we take care of it all for you. So yeah, that's just a quick rundown of those two taxes. If you have got any questions about any of those, feel free to send us an email or give us a call. And thank you for listening to my webinar today.